my biggest question this entire week is where we go from here. I don't like the idea of waiting and seeing. So if we are going to take an action, what is it?
No, that's a great question. I think a lot of it is kind of parsing out the short-term uncertainties versus the long-term of things that we have a high probability of relative certainty about.
Yeah.
Like for example, in let's say in 5 to 10 years, do we think average apartment rents will be higher or lower? I'd say with a great deal of certainty, near 98, 99%, rents are going to be higher still in the 90s, significantly higher in 5 to 10 years.
Yeah.
Now, where are cap rates going to go in that same period of time? That's a much more uncertain question because there's so many more variables that go into it that we're dealing with right now. So if you have but it comes back to kind of duration, time horizon, and it also comes back to why we have kind of structured our investments the way that we have. We've never taken a absolute short-term view of we have to turn this property around in 24 months or 36 months or even 4 years. We want to give ourselves the opportunity to minimize downside to as lowest probability as possible.
Yeah.
And one of the two main ways that we do that, there are many, but the two main ways, I'll just throw three in. One is buying right. You can do whatever you want, but if you've overpaid, you're just going to be digging yourself out of that hole for the foreseeable future. The second is having the option for a long-term hold and a long-term time horizon. Now, that's why we put long-term debt, typically 10-year terms, up to 35-year terms.
Yeah.
We've got some deals where we don't have to refinance or do anything for 30-some years. Well, now we're probably not going to hold it for 30 years, but if we wanted to, we could. Like on one deal, we've locked in a 2.9% rate for 35 years.
What is the cost? That was what I was wondering, because surely that there is, when you started to think about this long term, there was probably a temptation to take it short term.
Yeah.
But what are you sacrificing by taking that long term?
That's a great question. So it's a good point because we fixed some of this debt. We do limit some of our upside. So let's say the market turns around and just cap rates drop because interest rates drop and things are going gangbuster next year or 2 years from now. Some of our loans will be difficult, or some of the properties may be difficult to sell because we have a prepayment penalty. Now the price could be to a point where it makes sense or someone could assume the loan. But there's a good chance that we may not be able to sell some of these properties in 2 or 3 years because of the prepayment penalties. So, and if you could sell in 2 or 3 years, that IRR, because it's a time adjusted, time weighted metric, it goes way, 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 way up. Now your equity multiple may be way lower, but if you turn something around in 2 or 3 years, you're looking at, potentially, 30 to 40 IRR if you do a gangbuster job.
Yeah.
We've done those deals and that can happen, but you need to turn it around pretty quickly to get those, really high, double-digit IRRs.
Okay.
So we are foregoing the possibility of, we're going to not just hit a home run, but a grand slam in 2 or 3 years. But we've still have the possibility of hitting a home run, but it may be in 5 years.
Yeah. Okay.
And so we've reduced some of our upside, but we've traded that reduction in potential huge upside, and really only on an IRR basis, not on a multiple basis. But we've significantly limited our downside. We've we've made the chance of success incredibly high. Only possible with the kind of the third thing that we do, which is bring on significantly more reserves than is typically done.
Okay.
I've heard people say we bring on a year's worth of distributions, or an X percent of our equity or CapEx. Some people just bring in just the money for your CapEx and no reserves. I've seen some operators bring in essentially no reserves outside of the replacement reserves that they are required to deposit with their lender. And they're saying, oh yeah, we've got a reserve account. Of course we're putting reserves away. Well, you're putting $60 per unit per month away. It's not going to be, you're going to build up that account over time. Maybe you have to fund it at the beginning, but you're talking of funding in the $50,000, $100,000, $200,000 range, where we're bringing $1 million on of cash. Some maybe allocated for CapEx, but significant amount of dollars per unit, not 50 or 100, 200. We're talking more of the couple $1,000 per unit. So we've got projects where we're like, all right, we're still seasoning. We need to get it through this next year because we're going to lease up and a rebrand and all of that. But we're not worried that, like, oh, well, we need this to happen in 6 months. Otherwise, we're going to lose the investment.
Yeah.
Because we've got cash to carry the property for a year plus, maybe 2 years, which that won't be necessary. But it certainly allows me to sleep well at night, our investors to sleep well at night.
Yeah.
And so back to your question about investors and their concerns, we've been getting some feedback from investors. Not really on our deals, but they're working with other syndicators and sponsors, and they're saying, they're suspending distributions. They don't have the cash on hand. They've been buying all these assets with floating rate debt, and they've got caps, and maybe they're not going to be paying any more in the future. But their interest rate, they thought they were going to be paying 3. Now they're paying 6. Yeah, it's capped at 6 now, but your interest payment is doubled.
Yeah.
But not only that, you have to escrow a certain amount of money for those interest rate caps to purchase another cap in like 3 years or whenever your cap expires. Because the caps, which is like an insurance product, it only is good for a couple of years.
Oh, okay.
And basically the way they work is you buy this cap, which you have to pay a lot of money in today's market to buy, which is essentially an insurance product that, if interest rates cross this line, we're going to actually start paying you some money because your interest rate has just crossed this threshold.
Okay.
But at the same time, they're saying, well, the requirements of the loan is that you always have to have a cap in place. And we want to make sure you have enough money to buy that next cap when it expires in 3 years. So, in order to do that, we want you to set aside money, put it in an escrow account to save up for that cap purchase.
Okay.
And so as interest rates have continued to rise, that amount that they have to escrow has risen. And a lot of operators didn't realize that because when they got their quote, when they were buying it, they're like, yeah, your cap's here. Here's your strike price. Here's your duration. And here's your escrow amount. Let's call it, I don't know, $5,000 a month or whatever.
Yeah.
Just picking a number. Now that the forward curve has gone way up because everyone thinks the Fed is going to continue to raise rates.
Yeah.
All right. Well, now your escrow is going to be $15,000 a month.
Yeah,
and your interest rate has increased.
It's interesting to put yourself in those shoes, though. If you were, maybe a couple years ago, or maybe even just a year ago, what were your assumptions? Did you? I think that we were a little bit wary. People say inflation and interest rates in the same breath. We were talking about inflation last year, and it was hard to. That's just such a difficult decision to make.
Well, and nobody knew.
Yeah,
I mean, we were looking around. We're like, inflation isn't going away tomorrow. Because just, not being classically trained economists, and we're just we play one on YouTube, and but looking at it and seeing like, all right, well, all the price of these things are going to rise, but that's going to make the price of everything else rise, and then everyone's salaries are going to have to rise, and then rents are lagging, like the market rate's rising, but the actual people are paying are going to be a slower tick up, and then people are going to need to ask for a raise because the rents have gone up, and it's like, all right, are we going to have high inflation for the next decade? Probably not. Maybe. Probably not. But it wasn't going to be transitory 6 month, 1 year, like was sort of consensus in what the Federal Reserve and central banks thought, last year when they were still, doing quantitative easing.
I think all of those solutions that you talk about, whether it's buying right, having the relationships with the sellers and with brokers to be able to kind of know the market, and being able to get long-term debt, and then maybe even especially to bring on additional reserves, there are a lot of it has to do with scale. And if you don't have that scale, then it does seem like it would be a bumpy road in the next year or two.
Yeah, because let's say you're syndicating any type of commercial real estate deal, and you're having a hard time raising money, and you need $5 million to close, to bring to the closing table.
Yeah.
But typically, the money you have to raise is a decent amount in excess of what you have to bring to the table, because you need money for your CapEx plans. You need money for reserves. Most of the time, there's some fees associated with the deal, like an acquisition fee. You have to raise that money out of equity. And a sponsor who may have difficulty raising capital right now, which, by the way, everyone's having a hard time raising capital right now for all the reasons what we're talking about.
Yeah.
All of a sudden, they're like, well, I want to buy the property because I've got hard money on the line, non-refundable earnest money. And well, I've got the 5 million to actually close the deal, but I don't have the 6 million that would include my fees and reserves.
Yeah.
And so then the sponsor's going in, hungry. They're not making any money now, which is fine. They couldn't raise all the money to pay themselves, I guess. But that changes the way they're looking about the deal.
Yeah.
They're trying to recoup that at some point. And then if anything goes wrong, all of a sudden something breaks that's below your deductible or something that just insurance doesn't cover or whatever. You don't have any money if anything goes wrong.
That's what I keep thinking of is like, if you don't have the money to make, and I just think of it in simple terms, to make a repair, then if you're not prepared for that, then that gets really expensive. It seems like it's almost like you're buying a nice pair of boots that'll last you 10 years, or you're buying a new one every winter.
Yeah.
If you're back against the wall, then you maybe are going to take cheaper short-term solutions because you just don't have the capacity to make long-term.
And I think that's exactly is what happened when people were being led to just like, I'm going to use a bridge loan and I'm just going to use floating rate debt and I'm going to buy the cheapest cap possible because screw this, inflation's going to be transitory, rates aren't going to go that high. In March, I was looking at the dot plots in the futures curve. And I'm like, the Fed funds rate could easily be 5%. Like that's what they're saying it's going to be. Not that at that point, I'm like, I don't know if that will happen, but what if it does? And I remember talking to some other operators and syndicators, and they're like, yeah. They're like, but the floating rate just, it looks really attractive right now. So I can get the proceeds and the interest rate's lower, and I have to flex. The big, huge advantage of floating rate debt, and it's so enticing, is the low prepayment penalties. The lower prepayment penalty. And they're like, well, I want to hit that 50% IRR in, a year and a half. I just want to crush it. And so they're like, I'm going to lock it up because part of this is very true. There's risk in not being able to sell.
Yeah.
What if the best time ever is to sell 2 years? Well, we can't do that.
Yeah.
But if the market goes the other way, we don't lose any money. They may lose everything.
Yeah.
And I refuse to open that up. And then if that means limiting upside, I'd rather crush a 2.5 over 5 years or 3x over 10 years and miss out on the maybe 2x in 2 years.
Yeah.
And again, it's trading time. I like, the idea of, low, high speed, low drag is cool. But the managing other people's money, it's a huge responsibility. Yeah. And it's like, my goal is like, I want to win every time.
Yeah. Yeah.
I don't need the 5x.
Yeah. It's certainly a less stressful, and even just the sentiment of the market, we were saying even when things were going great, it's a little too exciting. It's a little too overheated. And on the macro and the micro scale, you can't, it just seems like it's not my life. I'd rather it have certifiable success that you work hard and do than aim to get lucky every time.
Yeah, exactly. We're investing. We're not gambling. We're not rolling the dice. And that's what I love about multifamily is that if you are okay with a longer term horizon, you are gonna make money and be successful. Yeah, it's going to work out if you can give yourself time and use time to your advantage. Instead of having time work against you. I mean, if anyone's ever traded options, like if you know what theta is, you can be right, but if the timing's wrong, your value is eroded just as time goes on. Yeah. And it go to zero. You could have made the right call at the right price, but time matters, and it can go to zero because you got the timing wrong.
So that's what I was thinking too. I was like, what decisions do people make? I'm thinking of markets, I'm thinking of place, but time is so important too. Whether you're talking about the duration of investment or the exact time in which you're going to invest.
But that's the thing, we can't time it. And so it's it's not timing the market. I think it's time in the market. And that may lead to you buying some things at a point in the market of where I think maybe in retrospect, maybe we paid a little bit more for that property. But if you're continuing to stay in the market, you will also pick up opportunities that are well below market and are great deals. Yeah. And we're starting to see that happen. The cracks that we've been talking about, Matt, over the last good 2 to 3 months about there's going to be some pressure. especially end of next year, early 2024, when a lot of these
Okay.
short-term loans are going to be coming due. But I'm already hearing about the pressure from other operators, syndicators, and investors, where a lot of these floating rate loans, the interest rates have gone up, the cap escrows have increased, which they weren't counting on. They didn't think that was going to happen.
Yeah.
And now rent growth is slowing and occupancy is dropping. So they were projecting 10%, 15% rent growth this year and another 10% next year. Well, you're going to get 7 this year and you're going to get 4 next year. And their exit cap projections were 3.5 or 4%. Well, cap rates are no longer 4%. They're 4.5 to 5%.
Yeah.
So the market has changed, and part of it is it's a healthy sign that like the economy is working and figuring things out and is oscillating and resetting. So it's fascinating from that standpoint. But man, I think having a long-term view is the only way.
Yeah.
The only way to do it.